Welcome to the Fear and Greed Daily Interview. I'm Sean Aylmer. I've spoken before about the potential for a hard landing in the US. The Federal Reserve is trying to slow the economy with price rises at 40-year highs. But can they do it without putting the world's largest economy into recession? And what does it all mean for investors? Roger Montgomery is the founder and chief investment officer of Montgomery Investment Management. Roger, welcome back to Fear and Greed.
Great to be with you, Sean.
So what would a hard landing look like? Well, firstly, define it for us. And what would it look like?
Well, it's a recession. For all intents and purposes, when investors talk about the fear of a hard landing, they're talking about negative growth in the economy.
A year ago, the Fed Chair Jerome Powell said inflation was transitory. Now, you've written a blog on this recently. Sort of 6 months ago, he led investors to believe rates would stay at zero this year. Now he sort of admits that the central bank was too slow in fighting inflation. It kind of doesn't help central banks' credibility, and as a result, it doesn't help investors much.
No, that's exactly right. So, investors have enough spinning plates to contend with without having to worry that the central banks of the world really don't know what's going on. And unfortunately, central banks now represent another plate investors have to spin. So, that uncertainty really raises the spectre of more volatility and therefore more risk. If you believe volatility is risk, which is not always true, volatility can often represent opportunity, but volatility nevertheless is likely to be greater in the bond market and also in equities, simply because we don't know whether or not the US Federal Reserve in particular, and of course it applies to all central banks, but the Federal Reserve in particular, whether they are behind the curve, ahead of the curve. We just don't know to what extent they're going to respond to the realization they are, if they are behind the curve, which I suspect they are. And in fact, as you said in your question, Jerome Powell admitted basically they're a bit slow. What the reaction or the response is going to be. If they can't get it right, then how is anyone else supposed to get it right? And I think that uncertainty is permeating markets at the moment.
Now, I'm going to be in defense of central bankers here. We are coming out of an incredibly unusual period where there's massive monetary and fiscal policy stimulus. Is it possible that this is just a difficult 12 months, 18 months, and central banks, once they get through this, will kind of go back to where they were before, managing the economy reasonably well? Or is it because it's a rising interest rate environment, not a falling interest rate environment, it's going to be much tougher for the central banks?
The short answer is yes. I think this too will pass. You're probably the most useful 4 words in the investing syllabus. In 5 years, we'll not be talking about this.
Yeah.
So, I think we'll be thinking about other things and worrying about other things. But you do have to remember that what the central banks did back after the GFC was in defense of economies that otherwise would have fallen into a depression. And so since 2009 onwards, we've had this unconventional monetary policy, declining interest rates and quantitative easing, taking that trough away. Nobody knows, because it was fundamentally a monetary experiment of the grandest kind. We simply don't know what it's going to be like when that trough is pulled away or when the punch bowl is taken away from the party. And that's what central banks are proposing to do right now. I suspect that they'll have to continue to stimulate for a lot longer to come. But at the moment, they need to make some adjustments because inflation is out of control.
Stay with me, Roger. We'll be back in a minute. I'm speaking to Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. Another thing in the blog that you wrote that I mentioned earlier on, you quoted a number of US investment banks talking about what they thought for the economy and the market. Is there a chance that we're talking ourselves into recession? We are so bearish, or those guys are so bearish?
Well, that's exactly what I said in the blog, that, as a consequence of what the Federal Reserve is doing and the comments that have now been made, the admission, for example, that the Fed was behind the curve after being so confident that, one, inflation would be transitory, 2, interest rates would remain at zero for a very long time, and 3, the Fed will move quickly to a neutral policy. Now they're saying, well, we're behind the curve and we admit that. So what's happening now is that investors are seriously questioning the whole paradigm that existed up to probably December last year. And that was interest rates remain low forever. You could pay pretty much any PE for a growth stock because they're continuing to grow, money's free, and there's no better alternative anywhere else. That paradigm has vaporized, and now investors are really starting to have to think about valuation, growth, reliability, robustness of business models. This is in the equity market, all the while in the midst of the biggest bond market sell-off that we've seen since the 1980s. And, that really is a massive shift in investors' thinking.
I mean, it's very difficult when you've got equities and bonds being sold off if you're an investor.
Indeed.
How should investors be thinking about markets and asset allocation and all that sort of thing at the moment, given what's going on?
Well, the bottom line is there's been nowhere to hide. My meetings with financial planners talking about equity performance has revealed to me that equity performance is, for many financial planners in Australia, is a sideshow because the vast majority of investors' money is invested in bonds, which was supposed to have downside protection or defensive characteristics, and it didn't. And layer on top of that your earlier question or your previous question about Goldman Sachs and Morgan Stanley, Deutsche Bank calling the mother of all recessions and significant drops in equities to come, layer on top all of that, and it really is making any advisor's job much, much tougher because there's no protection anywhere. There's nowhere to hide.
So what do you do? That may hold a lot of cash or something.
Well, unfortunately, in a high interest rate environment, your cash loses purchasing power as well, right? That's guaranteed to lose money. But mind you, minus 2% is better than minus 20. So cash is probably superior. Having said that, though, as I alluded to earlier, in 5 years' time, we won't be thinking about these things. And I suspect, well, what we've seen now is we've seen this absolutely fantastic compression in PE ratios. And that compression in PE ratios is going to result in better returns going forward for investors who are buying at those lower PEs. If you buy and sell a stock on the same PE ratio, let's call it 8 or 10 or 12, you buy it at 10, you sell it at 10, well, your return is going to equal the earnings growth of the underlying company, the earnings per share growth. So if you buy businesses whose PEs have compressed and a large portion, I think, of that work has been done, then you're now just trying to find companies that can grow. And if you can find those with defensible moats or competitive advantages that are sustainable, you can find those businesses and they do end up growing. And admittedly, the risk of recession means that analysts will end up pulling back some of their earnings expectations anyway. So there could be a little bit more PE compression, but you're going to get a better return than had you invested heavily in December. You're going to get a lot better return now. The lower the price you pay, the higher your return. And if you buy, as I said a moment ago, if you buy and sell a stock on the same PE ratio, your IRR or your internal rate of return will equal the earnings growth rate.
Okay. Roger, I don't like having this such a negative conversation on fear and greed.
Well, I actually think it's really positive.
But, my next question is then, what are you looking for? So there are opportunities in a sense coming up. What are the signposts that you're looking for that you start thinking, okay, things are turning? Is it a macroeconomic event? Might be inflation not going as hard in the US. What is it that you're looking for, I suppose, to start thinking differently?
Well, it's been macroeconomic influences that are driving the market to date.
Yeah.
And so it's likely to be the easing of those fears around a recession, the end to rising interest rates, the end of inflation and disinflation replacing accelerating inflation, disinflation being consecutively lower rates of inflation. You'll still get rising prices, but they rise at a slower rate. That environment, provided we've still got economic growth, if we've got economic growth and disinflation, that's very positive for innovative growth stocks. And so I suspect because macroeconomic influences have driven the market, I think it'll be the end of those fears that turns the market around, although the market at the moment is indiscriminate in its selling, which is actually a really good thing for investors. Indiscriminate selling means the baby gets thrown out with the bathwater. Good companies get sold off. And what's been happening recently, we've noticed, is that companies with defensive characteristics have become relatively expensive to the growth stocks. And so the growth stocks are becoming relatively cheaper. And we think ultimately your job as an investor, to quote Warren Buffett many, many decades ago, is to purchase at a rational price a part interest of an easy to understand business whose earnings you're virtually certain will be materially higher in 5, 10 or 20 years. And so what you want to do is isolate those businesses you believe are going to grow substantially and start buying, start dipping your toe in the water and buying them.
That is a great quote. So he's basically saying, buy things at a rational price, make sure you understand the business.
Yes.
And ensure they've got earnings growth in front of them.
They're going to be substantially bigger in the future than they are today. He goes on to say after that, actually, put together a portfolio of businesses whose earnings march upward over the years, and so too will the value of the portfolio.
Yeah.
It's pretty straightforward.
It is pretty straightforward.
And the market's handing you a gift. The market's saying, hey, we're worried about all these things that will pass in the next 5 years or 10 years. Here's a cheaper price for you.
Okay, we're going to finish this podcast much more upbeat than where I was a few minutes ago, Roger.
Good.
Thank you for talking to Fear and Greed.
It's an absolute pleasure, Sean.
Now, of course, this isn't an investment podcast. You should speak to a professional advisor before making any investment decisions. You've been listening to Roger Montgomery, founder and chief investment officer of Montgomery Investment Management. This is the Fear and Greed Daily Interview. Join us every morning for the full episode of Fear and Greed, Australia's most popular business podcast. I'm Sean Aylmer. Enjoy your day.